one of my very favourite studies, which shows that the effect is particularly strong in terms of a slow reaction for a customer earnings announcement. So what's all that about? So let's say there's a pharmaceuticals company which announces bad earnings. Who is it bad for? Well, it's bad for that pharmaceuticals company, but it's also bad for the chemicals company which supplies the chemicals to that pharmaceuticals company, right? If your customer has had bad things happen to it, it's going to be bad for the supplier. But you might not notice that. Why? Because how these investment banks and how these funds are divided is they're often divided by industry, right? So I used to work in investment banking in the chemical sector, and because I was already spending 20 hours a day studying these chemicals companies, I just didn't have time to figure out what was happening in the pharmaceuticals industry. So what that means is there might be relevant information happening in a different sector, and because people specialize by sector, they're not going to be noticing the information. And so here's a really clever trading strategy. If a company has bad earnings announcements, you short the supplier. And what the study found was that you would make 17% per year by trading on this. So this was designed by Lauren Cohen and Andrea Frazzini, where Andrea used to be at the University of Chicago, and he just got sick of actually being with Eugene Farmer telling him that markets were so efficient that he decided to leave and then set up and now join a hedge fund where he's implementing these strategies and doing very well on the basis of this research.